3 new tax credits for seniors. Aging at home. Don't leave money on the table. There's money sitting on the table right now. Money that belongs to Canadian seniors. Money that could cover medical equipment, home modifications, caregiving costs. Money that could make the difference between staying in your home or being forced into institutional care. And most seniors have no idea it exists. I'm Joseph, and what I'm seeing in the latest federal and provincial budget documents is deeply concerning. Not because these tax credits don't exist, but because the take-up rate is shockingly low. The Canada Revenue Agency's own data shows that millions of dollars in legitimate tax relief for aging Canadians go unclaimed every single year. This isn't about finding loopholes. This is about understanding what you're already entitled to under current Canadian tax law, and why the system seems designed to keep you from finding it. Let's talk about 3 tax credits that could be worth thousands of dollars to seniors aging at home. Here's what's been happening quietly. Canada is in the middle of a demographic shift that policy analysts have been warning about for decades. By 2030, nearly 1 in 4 Canadians will be over the age of 65. The strain on our healthcare system, our long-term care facilities, and our public pension programs is already visible. And the federal government knows this. Behind the scenes, there's been a strategic pivot. Instead of building more long-term care beds, which cost taxpayers roughly $150 to $250 per resident per day, Ottawa has been quietly incentivizing what they call aging in place. The idea is simple: keep seniors in their own homes longer. It's better for quality of life, it's better for mental health, and frankly, it's much cheaper for the government. But here's the problem. The tax credits designed to support aging in place are buried in the Income Tax Act. They're technical, they're confusing, and unless you're working with a tax professional who specializes in senior finances, you probably don't know they exist. I've spoken with retirement policy analysts, CRA tax specialists, and seniors advocacy groups across the country, and they all say the same thing. Awareness is dangerously low. The Canadian Association of Retired Persons released a report last year showing that fewer than 30% of eligible seniors claim all the credits they qualify for. That's not a small gap. That's a systemic failure of information. So today, I'm going to walk you through 3 specific tax credits that apply to seniors who are aging at home. I'll explain what they are, who qualifies, how much they're worth, and most importantly, how to actually claim them. Because leaving money on the table doesn't just hurt you. It sends a signal to Ottawa that these programs aren't needed, and that makes them vulnerable when budget cuts come around. Let me be clear, these aren't brand new credits that just appeared. But there have been recent expansions, clarifications, and policy updates that most Canadians missed. Credit number 1. The Home Accessibility Tax Credit, HATC. This is a non-refundable tax credit worth up to 15% of eligible expenses, with a maximum claim of $20,000 per year. That means if you qualify, you could reduce your federal taxes by up to $3,000 annually. The HATC was introduced in 2016, but it was expanded significantly in the 2022 and 2023 federal budgets. The list of eligible expenses now includes things that weren't covered before, and many seniors still don't realize what qualifies. Here's what you can claim: wheelchair ramps, stair lifts, and walk-in bathtubs, grab bars and handrails, widening doorways or hallways to accommodate mobility devices, lowering countertops or installing accessible light switches, non-slip flooring, even certain types of smart home technology designed to help seniors live independently, like voice-activated systems or automatic lighting. But here's the key detail most people miss. You don't have to be disabled to claim this credit. You qualify if you're 65 or older. That's it. Or, if you're under 65, you can still claim it if you're eligible for the disability tax credit, or if you're making renovations for a qualifying family member who lives with you. The CRA's definition of a qualifying individual is broader than most people think. It includes adult children living with aging parents or seniors supporting a spouse with mobility issues. And yet, according to the Department of Finance, this credit is dramatically underutilized. In the last fiscal year, fewer than 50,000 Canadians claimed it. But Statistics Canada estimates that over 2 million Canadian households include someone over 65 who could benefit from accessibility modifications. That's a staggering gap. Credit number 2, the Medical Expense Tax Credit, METC, Expanded Home Care Provisions. This one has been around for decades, but recent CRA guidance has quietly expanded what qualifies under the category of attendant care and medical equipment for home use. The Medical Expense Tax Credit allows you to claim eligible medical expenses that exceed 3% of your net income, or $2,635, whichever is less. For many seniors on fixed incomes, that threshold is easier to cross than you might think. Here's what changed recently. The CRA now explicitly allows seniors to claim costs related to full-time or part-time attendant care provided in the home, even if that care isn't provided by a licensed medical professional. This includes personal support workers who help with bathing, dressing, or meal preparation, nursing care at home, certain costs related to private home care agencies, even remuneration paid to a family member. Yes, you can pay your adult child to provide care and claim it as a medical expense, as long as you issue a T4 slip and they report the income. You can also claim medical devices and equipment, oxygen concentrators, hospital beds, blood pressure monitors, diabetic supplies, incontinence products, hearing aids, prescription eyewear, and more. But here's the part that catches people. You need receipts, you need documentation, and you need to know that the CRA's list of eligible expenses is updated regularly. Many seniors assume their costs don't qualify, so they don't even try. That's a mistake. If you're spending money to manage a medical condition at home, there's a strong chance it's claimable. But you have to ask, you have to track it, and you have to file it correctly. Credit number 3, the Disability Tax Credit, DTC, and its impact on aging Canadians. Now, this one is often misunderstood. The Disability Tax Credit is a non-refundable tax credit worth over $9,400 federally for 2024, and it can be even higher when provincial credits are included. But most seniors don't think of themselves as disabled, so they never apply. Here's what you need to understand. The DTC isn't just for people in wheelchairs or with severe cognitive impairments. It's for anyone with a prolonged physical or mental impairment that significantly restricts their ability to perform basic activities of daily living. That includes walking, dressing, feeding yourself, managing bowel or bladder functions, hearing, speaking, mental functions necessary for everyday life, like memory, problem-solving, or judgment. If you need help with any of these activities, or if it takes you significantly longer to perform them than it would for someone without an impairment, you may qualify. And here's why this matters so much for seniors aging at home. If you're approved for the DTC, it unlocks access to other benefits. You become eligible for the Registered Disability Savings Plan, RDSP, which can include government grants and bonds. You can claim the full amount of attendant care expenses without the income threshold limits that apply to the METC. You automatically qualify for the Home Accessibility Tax Credit regardless of age, but the approval process is complex. You need a medical practitioner to complete Form T2201, and many doctors are unfamiliar with the criteria, so they don't fill it out correctly the first time. According to a 2023 report by the Office of the Taxpayer's Ombudsperson, nearly 40% of initial DTC applications are rejected, not because the applicant doesn't qualify, but because the form wasn't completed properly. That's unacceptable. So who needs to be paying attention to this? First, Seniors over 65 who are living independently but starting to need modifications to stay safe at home. If you've thought about installing a stair lift, widening your bathroom door, or adding grab bars, you likely qualify for the Home Accessibility Tax Credit. Second, family caregivers. If you're an adult child caring for an aging parent, or if you're a senior caring for a spouse, you may be able to claim attendant care expenses, even if you're the one providing the care. This is especially important for middle-income families who are stretched thin. Third, retirees with chronic health conditions, diabetes, arthritis, COPD, heart disease, mobility issues, vision or hearing loss. These are all conditions that generate claimable medical expenses. If you're managing any of these at home, you should be tracking your costs and filing them with the CRA. Fourth, seniors receiving CPP, OAS, or GIS. These credits don't reduce your pension income, but they do reduce your taxable income, which can help you stay under income thresholds that determine your GIS eligibility. This is critical for low-income seniors. And finally, near retirees in their late 50s and early 60s. If you're planning for retirement, understanding these credits now will help you structure your finances more effectively. You can start making home modifications before you retire and spread the tax benefits over multiple years. Let's talk real numbers. Imagine you're a senior couple. You're both over 65. Your combined income is $60,000, mostly from CPP and OAS, with a small amount from RRSPs. You spend $12,000 on a stair lift and bathroom modifications. You claim the Home Accessibility Tax Credit. That's a $1,800 reduction in your federal taxes. You also spend $4,000 on prescription medications, a walker, compression socks, and a blood pressure monitor. After the 3% income threshold, you can claim about $2,200 in medical expenses. That's another $330 in tax savings. If one of you qualifies for the disability tax credit, that's an additional $9,400 in non-refundable credits, worth about $1,400 in tax savings federally, and potentially another $500 to $800 provincially, depending on where you live. Add it all up, and you're looking at $3,500 to $4,000 in tax relief. For a couple living on $60,000 a year, that's significant. That's 2 months of groceries. That's a year of home heating. That's the difference between financial stress and financial stability. And if you didn't claim these credits, that money stays with the government. Now multiply that across millions of Canadian seniors. You start to see why advocacy groups are calling this a crisis of awareness. So why isn't the government doing more to promote these credits? There's no conspiracy here, but there is a tension. On one hand, the federal government genuinely wants to support aging in place. It reduces pressure on healthcare systems. It aligns with what seniors say they want, to stay in their homes as long as possible. On the other hand, every dollar claimed in tax credits is a dollar the government doesn't collect. And with rising deficits, inflation pressures, and an aging population driving up the cost of OAS and healthcare, Ottawa is walking a fiscal tightrope. The Parliamentary Budget Officer has warned repeatedly that current spending on seniors' benefits is unsustainable without significant reforms. We've already seen this play out with the OAS clawback threshold, which hasn't been indexed properly for years. So while these tax credits exist, there's little incentive for the CRA to aggressively market them. The system is designed to be permissive. If you know what to claim, you can claim it. But if you don't, the government isn't going to chase you down and hand you money. This is why financial literacy and awareness are so critical. The burden is on you to know your rights under the tax code. Pension experts and seniors advocates are increasingly vocal about this issue. Laura Tamblin-Watts, CEO of CanAge, has called the low uptake of these credits a hidden tax on seniors. She argues that the complexity of the system disproportionately harms those who need help the most, low-income seniors without access to professional tax advice. The Canadian Medical Association has raised concerns about the disability tax credit application process, noting that family physicians often lack the time or training to complete the forms properly. They've called for standardized training and simplified criteria. Provincial governments are watching closely. British Columbia and Quebec have introduced their own parallel credits for home accessibility and caregiving. There's growing pressure on other provinces to follow suit, but there's also frustration. Seniors advocacy groups argue that tax credits are a poor substitute for direct investment in home care services, which would eliminate the need for seniors to front the costs and then wait months for a refund. That's a fair point. But until those systemic changes happen, the credits we have are the credits we need to use. Here's what you need to do. Step 1. Review your expenses from the last tax year. Go through your receipts, your credit card statements, your medical records. Identify anything that might qualify under the Home Accessibility Tax Credit or the Medical Expense Tax Credit. Step 2. If you haven't already, file your taxes or file an adjustment. You can go back and amend your return for up to 10 years if you missed claiming something. Use Form T1ADJ to request an adjustment. Step 3. If you have a chronic health condition or mobility issue, talk to your doctor about the disability tax credit. Be specific. Explain how your condition affects your daily life. Ask them to complete Form T2201 carefully and thoroughly. Step 4. Keep meticulous records going forward. Every receipt, every invoice, every expense related to aging at home. Create a dedicated folder, physical or digital, and keep everything in one place. Step 5. Consider working with a tax professional who specializes in seniors' finances. Yes, it costs money, but if they can identify $3,000 or $4,000 in missed credits, they'll pay for themselves many times over. Step 6. Stay informed. The CRA updates its guides and eligibility criteria regularly. Subscribe to updates from organizations like CanAge, CARP, or the National Institute on Aging. These groups track policy changes and translate them into plain language. And here's a critical point. Don't assume you don't qualify. The worst thing you can do is self-disqualify without even trying. If you're not sure whether an expense is eligible, claim it. The CRA will either accept it or deny it. But if you don't claim it, you've already denied yourself. Looking ahead, I expect we'll see more focus on aging in place, not less. The demographic pressures aren't going away. The cost of institutional care is rising. And the political reality is that seniors vote, and they vote in large numbers. But I also expect we'll see more scrutiny of these programs. As deficits grow, there will be calls to means test benefits, to tighten eligibility criteria, to cap claims. We've already seen this with OAS, we've seen it with the age of eligibility for certain credits, and we'll likely see it again. That's why it's so important to claim what you're entitled to now, while these programs are still accessible. There's also a broader conversation happening about tax policy and fairness. Some economists argue that tax credits disproportionately benefit higher-income seniors who can afford to make large renovations and then claim the credits. They argue for a shift toward direct subsidies or grants for low-income seniors. That debate is worth having. But in the meantime, the system we have is the system we need to navigate. Here's the bottom line. These 3 tax credits, the Home Accessibility Tax Credit, the Medical Expense Tax Credit with expanded home care provisions, and the Disability Tax Credit, represent real money that can help Canadian seniors stay in their homes longer, with dignity and financial security. But they only work if you know about them, and they only work if you claim them. The government isn't going to send you a letter telling you what you're missing. The CRA isn't going to call and offer you a refund. The responsibility is on you, or on your family, to understand the system and use it. I know that's frustrating. I know it feels like the system should be simpler, more transparent, more accessible, but until it is, awareness is power. So share this information. Talk to your family, talk to your neighbors, talk to other seniors in your community, Make sure people know what's available, because every dollar left on the table is a dollar that could have made someone's retirement a little easier, a little safer, a little more secure. If you found this helpful, please subscribe to the channel, share this video with anyone who might benefit, and leave a comment below. Tell me what other topics you'd like me to cover, or share your own experience navigating these tax credits. I'm Joseph, and I'll see you in the next one. Stay informed, stay prepared, and don't leave your money on the table.